Okay, we're good. Thanks, Don.
Great. Welcome everyone to tonight's asset protection webinar. We are delighted to have Scott Estill back with us. It's been a while since we had Scott on, and he is such a wealth of information and a genuine, nice, good man. And so we're delighted to have him. Scott, thank you for being here and for your time. Before we get started, though, I wanted to just do a couple quick announcements. We're planning 2 events right now. There'll be 5 summits throughout the year, but the 2 that are open registration right now is Nashville, coming up February 24th through the 26th, and Phoenix, which would be April 27th through the 29th. And you'll notice that all of the webinars in 2020 will be Monday, Tuesday, Wednesday events. We've had such a hard time scheduling weekends with our speakers and with hotels. We've just gone to Monday, Tuesday, Wednesdays on all of them. And Nashville, we've got a great hotel. In fact, both of them. We've got great hotels. As soon as you go to protectwealth.com and register, you automatically get an email from us saying, thank you for registering. Here's the hotel information. And the hotels fill up fast. We usually book about 100, 150 room nights for our students, which is our commitment to them. And we're a little apprehensive about going over that commitment, but Nashville is filling up very fast. So don't wait too long on your room block, or we've negotiated some really good rates, and we don't want you paying a lot more than you have to. So Nashville and Phoenix, those are the 2 that we're registering people. If you haven't been to one of our summits, what we're doing is we're bringing some of the best of the best of the best in asset protection, in wealth creation, in tax reduction, estate planning. We're bringing them to the table to be your instructors, and then we give you a chance to sit down with almost all of them and go over your estate. It might be their staff members if we get too many people, but we're giving you a chance to sit down and strategize, not just a seminar workshop environment. If you're looking for a sample agenda, we don't change it all that much, so a sample is pretty good. It's posted at protectwealth.com. We invite you to go take a look at what we're doing. You'll find that it's not a wussy little seminar. It is full on asset protection, and we're delighted to have you. We're also booking currently for our high yield investor cruise coming up December 6th through the 13th. I won't take a lot of time, but we're leaving Miami, going to Puerto Rico, St. Martin, and back to the Bahamas. We are going to have an incredible time. If you haven't joined us on a cruise ever before, we've had some incredible instructors throughout the years, and we're still finalizing the webinars, or the speaker lineup. We've got more than half of them. We know Mike Koval will be there. We know that somebody from Gene Garino's group will be there. We're putting together a great lineup. But we're booking that now. And on our website, there's the full itinerary. We hope that you can join us on that cruise. The price on it ends up being about $600 for tuition and then the cost of the cruise. So we could not make it any easier for you. There won't be better education anywhere in the U.S. on these asset protection subjects. And so, again, we invite you to think about that. So before we turn time over to Scott, there is always a tax and legal disclaimer that the principles that we're going to talk about tonight and always on our stage are general by nature. We try to be very, very accurate, very timely in what we do, but whether these principles apply to you and your situation is really an opportunity for you, and you're a tax professional, to sit down. Again, that's why we spend so much time doing consults during our 3-day summits, is we want you to have good information that's applicable to you. So with that, You didn't come to hear me, so I'll turn the time over to Scott. Again, we're so delighted to have him. It's the perfect time, last minute tax strategies. Scott was a former senior trial attorney from the IRS. Since leaving them, he's a prolific author. He's run his own law firm for almost 20 years. He sued the IRS, I don't know how many hundreds and hundreds of times, and he just knows taxes inside and out. What a wealth of information. And again, we're delighted to have you. Scott, thank you for your time, and we're going to turn time directly over to you.
Well, thank you very much, Don. It's always my pleasure to do the webinars, and this one I think it's going to be a little bit different than any of the ones I've done in the past. And in fact, I had to kind of create this one from scratch because there's been so many different changes with the tax law, and trying to keep up with all the changes is virtually impossible for certainly for any of us on this call tonight. And I do this stuff pretty much full time, but for me to be able to keep track of everything is very difficult. And I can imagine for somebody that's in business, obviously, that's not a tax person, you're going to have a hard time keeping up with all the changes. So hopefully tonight, the purpose being that we can take a look at what we can possibly do for the next, I guess, 20 days or so that's left in the year, and then also look forward to 2020 and beyond. So not only do we want to look at, maybe there's one or two things we can do before the end of the year, but how can we start 2020 off sort of on the right foot? Let's get in January 1st, let's make sure that if there were any mistakes or anything that we did last year that, we don't want to repeat, or we want to do some things differently, we can do that from a tax perspective. So anyways, let's look at where I would begin, I think, if I'm going to start with this sort of tax planning tomorrow here, and not that I'm expecting anybody to be tax planning beginning tomorrow. Hopefully you've done that throughout the year. But
Hey, Scott, can I interrupt you just a second here real quick? Look,
absolutely.
The format for tonight's webinar is we will go, Scott, I assume you'll teach for about 40 minutes or so and then open it up to Q&A. If you have questions, we invite you to write them in your question screen, and then we'll try to get to them. And the sooner you can write your questions, the better opportunity. We do have a hard cutoff at 8 o'clock Mountain Time, maybe just a couple minutes before. So there'll be a lot of questions. If you have questions, get those in early. Any other format stuff? Sorry, should have covered that in the intro. But Scott, thank you again for your time, and look forward to your presentation.
Oh yeah, no problem, Don. So as I was saying, as far as the tax planning goes, the two checks that you see on the top of the screen here, get organized and get educated, I think are the two places that I would start. I'd want to make sure that anything that you've spent money on for your business, that we can look at your business versus personal, we can separate out all the expenses, we can get a really good feel for where we are in 2019. And I know a lot of you that are in business, or let's say you have your rental properties, or maybe you're trading in the stock market, you may have a profit and loss statement that's quite up to date, so that you could say, as of November 1st or December 1st, my net income is X, and these are some of the strategies I've done, these are some things I'm looking at. But without the organization, without the education, you're really going to have a really, really uphill struggle to figure out how best to succeed here. I would then go about and pull out the 2018 tax return, or returns if you have businesses or whatever, and I would try to figure out, is 2019 going to be the same as 2018? Meaning, is it similar in terms of expenses, in terms of income, in terms of what your taxes are going to look like? Or has 2019 seen a real big increase or decrease in the income or expenses? And so if things stay kind of the same, I would expect the taxes to look very similar in 19 as far as 18 goes. And so whatever results you got in 18, you're probably going to get the same results in 19 unless you do something different. So we want to be able to look at all the, like I mentioned, the business, the rental real estate. We want to look at any stocks or securities or bonds or anything that we're trading. And then we also want to see if there were any life events in 2019 that maybe were, something that was a one-time type of event. If marriage, divorce, children, death, any sort of starting a new business, anything where we've got a big change. And I think when we put all this together, we're gonna start to see some patterns come up as far as what we're doing with taxes in 18, where we are in 19, and then hopefully where we're going to be when we get into 2020. So for this webinar, what I've done is I put together 13 little segments here on some things that I think you may want to look at between now and the end of the year. And I'll repeat this slide again at the end of the webinar just so you can see kind of this is where we're starting, and then you'll see that hopefully we've covered all of this stuff. And as Don mentioned, if you have questions, by all means, get them in the question format here, and I'll try to get to as many of the answers as we can. But tonight, I'd like to look at the withholdings and the estimated payments to make sure that we paid enough money in, look at the flex spending accounts, annual gifts, and we're going to look at some of the retirement plans, IRAs, Roths, 401ks, that sort of thing, along with stock market capital gains and losses. And then we look at timing issues with personal and business, whether they're deductions, whether they're income, and then how can we shift income around with maybe with our children, with different business entities, and this qualified business income deduction, and some college and education type planning. So a lot of different areas, and certainly not all 13 of these areas are going to apply to any one of you. And so, but I think, if you look at some of these, certainly number 1 here, number 3, number 5, number 6, number 7, and 8, 9, 10, these can all apply to pretty much everybody on the call. So, with that in mind, I mean, let's at least take a look at where we need to be as far as our payments go. And I would start with the 2018 return and look at the total tax that was due on that return. So when you go down and you look at, all the different taxes, whether they're income tax or whether they're self-employment taxes or maybe alternative minimum tax, all these different taxes that can apply, look at the 2018 return and see what the total amount of those taxes were. And then I would compare it to 2019 and look at whatever's been withheld from my wages, plus any amounts that I've paid in on these quarterly tax payments. And if there's a big difference between the two, let's make sure that we make our fourth quarter payment by mid-January here, this January 15th date, so we don't get penalized. But I think that's just mainly so that we don't get any rude surprises that, if we're in a big refund situation, it'd be better to know that now rather than later. And likewise, if we're going to owe, is there anything we can do between now and the end of the year to make what we owe quite a bit less? So one of the first tax strategies that I look at are concerning accounts that have some sort of tax deferral benefit, whether they be retirement plans, which we're going to talk about in a few minutes, or some of like the flex spending accounts where we can get these money going into these accounts before we pay any tax. And so on a pre-tax basis, money goes into the flex spending account. But one of the problems with these accounts is that we have a use it or lose it situation. And so any amounts that are left in the account after December 31st are typically lost. And obviously we don't want to get into that position. Some of the plans do offer extensions. They'll give you a 2.5-month rollover period. But either way, it's going to be a short window. And so check the account. Let's make sure that if there is anything in there, let's use it and let's not lose it. And so I've put this little blurb up there in the right, I guess, a little a picture of publication 502. And that's one that I'd recommend that you get because it shows all the different medical expenses that you can use for the different health savings accounts, like spending accounts, different self-employed health insurance accounts, 105B medical reimbursement plans, whatever, a whole lot of different plans. So, if you're going to use medical exams or any medicine, medical elective procedures, but there's a whole lot of first aid supplies. You can use batteries for hearing aids, dental work. So I'd recommend if you're in this position where you may have a use it or lose it situation, pick up this publication 502, available at irs.gov, and hopefully there you can see what sort of expenses may qualify for this. Again, we don't like to see you lose any of these tax benefits that you've worked hard to obtain. The gifting question comes up a lot of times when I speak, and certainly when I did the last 3-day wealth event back in Las Vegas, I think it was about a month ago or so, got a lot of questions on the gifting, and they seem to come up quite a bit this time of year because we've got the end of the year. Should we make gifts? Should we do any estate planning? A lot of this can come up in the last month of the year. So for 2019 and 20, our gift tax exclusion is $15,000 per person per year. And if we're married couple can give $30,000 to any one person. And again, remember this is $15,000 per person, does not have to be a related person. So you can gift these amounts to anyone that you want. Understand though that when you do make a gift, you do not get a tax deduction for the gift, and the person who receives the gift does not pay tax on it. So if I make a $15,000 gift to my daughter, I get no tax deduction. She does not pick it up in income, and it's just basically a wash or a neutral tax event. Notice too at the third bullet point here that $15,000 gifts do not involve using any portion of the estate tax or gift tax exemptions. So IRS, this doesn't get reported to the IRS. IRS doesn't know about the gifts, and we're just going to record on the check, if it's a check or some sort of a letter, some sort of a document just stating that, this $15,000 or whatever the amount is being used as a gift for the 2019 year. And when we're looking at this, when I said it doesn't matter, it doesn't get into the estate tax exemptions, this is what we're playing with as far as the current estate tax exemption. And what this number means for 2019 here, this 11.4 million, is that if a person passes away in 2019 and their total assets are less than 11.4 million, they don't owe any estate tax. And the question mark on the 2021 through 25 is that we don't know what this estate tax exemption is going to be. We do know that under current law, in 2026, it reverts back to where it was back in 2017 with some sort of an inflation factor coming in. But I've got a question mark there because we don't really know what the actual tax exemptions are going to be. We don't know who's going to be in Congress. We don't know who the president's going to be. And we don't know what any new tax laws are going to get passed, let's say in 2021, when we may have some new members of Congress or a new president. And so something to think about here where we go back to the last slide and we say the $15,000 gifts don't involve using any portion of this exemption. For most of us, we don't really care about this today because we're not worth 11.4 million or more. But what I would like to at least have you think about is that this 11.4 million is not necessarily going to be this high again in the future. So this 11.58 million, that number in theory could go down to $1 million or some other number that would capture a lot more of us in its net here. I think one of the benefits though of looking at the annual gifts right now, this time of year, is that we can look and plan for 19 and 20 at the same time. And what I mean by that is that you could make a gift, let's say, you could make a $15,000 or a $10,000 or a $5,000 gift, let's say on December 20th, and then turn around and do the same type of gift on January 10th. So we would have a gift for 2019 and then a gift in 2020. And obviously we could do this on New Year's Eve and New Year's Day and make them a day apart. But it gives us opportunities to make these gifts, and it does some estate tax planning as well. The fourth bullet point here, the benefits in that it removes an asset from the estate. Note also it removes the appreciation on that asset from the estate as well. And so what I'm trying to get at here is that if you make a $15,000 gift, let's say it was a gift of $15,000 worth of stock in some company, and then that stock appreciates, not only are we getting rid of the $15,000 from the estate, but we're also getting rid of the appreciation as well. And again, that may not make a difference if the estate tax exemption is $11.4 million, but if it becomes down quite a bit down from that, which I think is certainly very possible, maybe not probable, but I think it is certainly possible. It's something that we need to plan. Now, the $15,000 gift exclusion amounts, you could give quite a bit more than that. So if you wanted to give somebody $100,000 this year, you would have to file a gift tax return. And so on that gift tax return, we would exclude $15,000, and the remainder, the $85,000 in this case, would then have to be reported for gift tax purposes. There would not be any gift tax due as long as you haven't gone over that $11.4 million of gifts, but it would bring down that number by, in this example, $85,000. So again, something to think about, that the gifting works really well at quite a bit of different levels, whether it's gifting to your children, grandchildren, possibly going up the food chain as well and gifting to parents if they're in need of money or whatever. But a lot of tax planning can come in with the gifts because it allows us opportunities to be able to shift money, shift investments within our families to produce the best tax results. So at the 3-day summits, a lot of what we talk about, whether it's myself or one of the other speakers, a lot of what we talk about is looking at business entities and tax planning and asset protection, whatever, and differences between different corporate and LLC type of business entities. But what we don't look at a lot of times is the intra-family planning, the ability for us to be able to maybe shift income to our children or to somebody else in our family who may be in a lower bracket. And I'm going to talk about that at the end tonight here as far as paying our children. But it's something that I want you to think about, that not only do we look at the difference between, let's say, a C Corp and an S Corp, or a partnership or a sole proprietorship, but we also should be looking at parent versus grandparent versus child versus grandchild versus whomever in the family, that we may be able to move money around legally and be able to reduce our tax bill. Okay, so let's look at another strategy that I think any of us that are over age 70 and a half can take advantage of. And I know that there's, I'm getting close to that point. I'm not quite there yet, but when we do get to this age 70 and a half, another weird number from the IRS, all of us need to start taking what are called RMDs, or these required minimum distributions. And they have to come from your traditional IRA, qualified plans, 401ks come into play. Basically anything that's not a Roth IRA or a Roth 401k. And when we're looking at the required minimum distributions here, for somebody that turns 70 and a half this year, this 27.4 number is the actuary number that the IRS uses to determine what the amount of the required minimum distributions need to be. And I've got this little Pub 590 down there in the bottom right. And I'd recommend that anybody that's in this position, that's getting any distributions, or even that wants information about making contributions to an IRA, that you get this Pub 590. Again, it's at irs.gov, and it's free, and it's actually pretty well written. And so, but basically what the 27.4 years does is that if we're going to have to start taking our RMDs in 2019, we're pretty much taking the total of all of our IRAs, dividing it by 27.4, and that's going to give us a pretty rough approximation of what the actual amount is that we're going to have to withdraw. And of course, when we withdraw this, we're going to be paying tax on it. And so one of the strategies to avoid this is to look at the charitable contribution component of the RMDs. So one way you could do this is you could take out, let's say you had to take out $100,000 from your IRAs. You could take $100,000 out and report that as taxable income, and then make a $100,000 donation to your charity, and then claim that on your itemized deductions. But there's limitations on the charitable deductions on the Schedule A, which is how you report it on the personal return. So a better way to do this would be to have the IRA make the donation to the charity directly. In other words, you don't ever get possession of the money. And we can do this up to $100,000. So you're able to say to your IRA custodian, I have to take out $50,000 this year in RMDs. I want you to donate that to charity XYZ. By doing so, the charity gets the direct donation. You never report the income, and basically it's a win-win for everybody here, perhaps with the exception of the IRS, because we're going to pay less in tax by doing it this way. So if we do it this way, we have the charity get the money directly from the IRA. We don't get a tax deduction for the donation, but remember, we also don't pay income tax on the amount of the distribution. So if you're in this position where you've been doing RMDs in the past, this donation can apply for this year as well. And we still have a couple weeks left in the year to be able to make this type of strategy and decide maybe we don't need some or all of the amount of money that we're receiving from our IRA, or maybe we can make this donation and get the tax benefits this year. And certainly you could do the same for 2020 as well. Do that early in the year if that's something you want to do. Have the charity get the benefit of the money early in the year, I guess. So again, lots of different possibilities here with the IRAs and with the retirement plans as well. Okay, so contributing to a retirement plan, in my opinion, the number one mistake that small business owners make every single year is the failure to set up and contribute to a retirement plan for the business. And I know that you get into certain issues when you have a lot of employees or something where you can't discriminate and you have to cover everybody. But again, I've seen so many small businesses with one or two employees, and maybe the owners are the only employees in the business, and yet they don't take advantage of the opportunity to get these investments as a tax deduction this year, and then also have this great tax deferral or tax-free income over the future years. And so it's something that I want everybody on this webinar and listening to this recording in the future here to think about, and that is get your retirement plan set up and get some money going in there, even if it's not much, even if it's only a few $100s. At least get in the habit of starting to fund these plans. And the reason that they're so good is that they allow us typically quite a bit of money that we can put into one of these plans. So at the bottom here, the last two lines here, the IRA and the IRA catch-up, relatively small amount of money. So anybody on this call, if you've got earned income, meaning wages or some sort of guaranteed payments or whatever to a partner. But anyways, as long as you've got earned income of at least $6,000, you can contribute to an IRA. And if you're age 50 and over, you can contribute an extra $1,000 to that. So we're limited here to 6,000 or 7,000, depending on what your age is. But the businesses can do quite a bit more. And this is where the real bang for the buck can come in. If you look at the 401k and you look at the SEP, the maximum amounts are going to be the same. And you see that on the 56,000 for the SEP, and then you have the 19,000 and the 37,000 on the employer match, adding up to the 56 grand. Of course, there's the catch up in the 401k that applies. It doesn't apply to a SEP plan, but at least we can look at some of these numbers and figure out, all right, I can set up a 401k plan this year, and I could set it up today, and I can contribute to it in the next couple weeks and get the tax deduction for 2019. So this is something that a lot of you can take advantage of today. You can certainly talk to your financial advisor to determine which of these plans is going to be appropriate for you. Talk to your tax advisor as well. But you're going to be making investment decisions, obviously, with however you're going to invest these proceeds. So you do have to make some decisions there. But I think the big tax point of this is if we look at the very first line here, and I make a 401k contribution of, let's say, $19,000. And let's say my employer only matches $1,000 of that. So I get this $20,000 going into my IRA. Number one, the business gets a tax deduction for that $20,000. So whatever, even if the investment itself, the 20 grand gets invested into something where it earns absolutely nothing, we're still getting the value of the tax deduction in 2019. So if we're in the 30% bracket, on that $20,000, we may save $6 grand in tax. So we still have the tax benefits on that contribution this year. And then whatever that 401k investment earns, so that 20,000 turns into, let's say, 40 or 50,000 over a period of time, we've never paid tax on any of those earnings. But yet, so many small businesses don't look at this as great of a tax planning opportunity as it is. And it gives you opportunities to do quite a bit of different things. You can do real estate in your IRA. You can trade options, bonds, stocks, so many different things you can do. So you're not limited to strictly a mutual fund or some other sort of ordinary type common investment. But again, this is something that everybody on this call needs to consider. And if you've already made the contributions, make sure you've maximized them. If you haven't made the contributions or you don't have one of these plans, let's try to get one. And there's still time here, as the next slide here is going to show. But before we get to that, Roth IRAs, there's a phase out for contributions here. And the first number there, the 137, is for this year. It goes up by $2 grand for single people in 2020. And then you can see there's a $3,000 bump up for married individuals. So if I'm married and my taxable income is $100,000, I can make a Roth IRA contribution in 19. Let's say my income is $300,000. I'm phased out of that, and I would have to make a traditional IRA contribution because I would not be able to do the Roth. Now I may be able to convert to the Roth, and I'll talk about that in a few minutes. It's also possible to get a tax deduction for a traditional IRA, but notice that these amounts that I have here for 2020, they're $1 grand less for 19, but basically the same thing if we're not covered by a plan at work. So if you have a 401k at work, you can still make a contribution to a traditional IRA. You just won't get a tax deduction for it. But still, it still can be a good tax plan and a good financial planning move as well. Now, as far as the due dates, as far as when we can contribute to these plans, notice that the simple plan, we're done. So if we want to do a simple plan, we can set it up for 2020, but we can't fund it for 2019 because we missed the cutoff. But for the 401k, we can fund that, actually set it up and fund it by the end of the year. In an IRA, we can actually do retroactive tax planning, and a SEP is also a type of an IRA, the simplified employee pension, and so we can actually fund that in 2020 or 2019. So it's really one of the only ways I can think of that we can retroactively do some tax planning and do it legally. So we're not backdating documents or doing anything, silly that's going to get us into potential trouble with the IRS. But here's something where we could make the contribution in April of 2020 and make that for 2019. I like to see these contributions get made as soon as possible, though, so you can get the benefits of either the tax deferral, or if it's a Roth plan, the tax-free nature of all the investment income. But again, understand that we have options here as far as when we can set these types of plans up. Now, as far as the plans go as well, one of the strategies that a lot of us look at, and this can be a kind of a tough planning one, is going to be Roth conversions. And what I mean by that is taking a traditional IRA and converting it to a Roth IRA. The benefit being that once it's converted, the Roth IRA then can earn as much money as it wants, and all of it becomes tax-free. The downside to a Roth IRA conversion is that when we make the conversion, there's a taxable event in the year of the conversion. And so if we convert $50,000 of a traditional IRA to a Roth IRA, some or all of that $50,000 is going to be taxed in 2019. And so obviously, if we're going to be doing that, we need to be making sure that we're taking advantage of maybe some lower tax brackets, or maybe absorbing some excess tax deductions to be able to take advantage of this. So what do I mean by this? Well, if we expect us to be in a very low bracket tax-wise in 2019, but not in 20, if we convert some of the traditional IRAs to a Roth IRA in 2019, the amounts are going to be taxed at a lower amount than if we would do it in 2020. Or maybe we have a lot of deductions, various expenses in 2019 that we're not going to have in 20. And so we use all the expenses, and then we can have some additional income to absorb these tax deductions by way of the Roth conversion. It must take place by the end of the year, though, if we're going to do it, but we're going to have income tax issues here. And interestingly, one of the questions, or one of the first questions that we got for this webinar actually came in early this morning, and it was a question from Jason, and I don't know if Jason's on the webinar here, but his question concerned, if we're going to be doing these conversions from a traditional IRA to a Roth, how do we reduce our taxable income, or how do we manage this? And that is a really, really good question, and it's one that I think all of us really need to play around with, so that we have a pretty solid answer for this. And I'll be talking about how we can look at some bunching of income and expenses and what have you to hopefully get at the point of where Jason's question was coming from. But one thought we can do here is that we don't have to do all of these conversions in 1 year. So let's say that we have $100,000 in a traditional IRA that we want to convert to a Roth. And we do the tax calculations if we convert it all this year, and we don't like the results. So we can decide that we could convert $50,000 this year and $50,000 next year, or maybe $25,000 this year and do that over the next 4 years, spread it out over 4 years. So we don't have to do it all at once, so we can control the amount of taxes that we're going to have to pay on the conversion. When I say mind the tax brackets, what I'm talking about here is that if you expect your brackets to change substantially from year to year, going up and down, let's try to time the Roth conversions to a year where you're in the lowest bracket possible. And I know that's not always possible, but certainly for a lot of us that are self-employed, or maybe have income fluctuations from year to year, this is a strategy that you can use to a really nice benefit. Also, tax law changed in 2018 that once you do this conversion, you're stuck with it. You can't undo it. And so undoing these Roth IRA conversions was something that we looked at in 2017, and real nice strategy, but not so much anymore for 2018. So, all right. Next topic here. I know this is quite a bit of stuff, but I'm just trying to throw a lot of stuff at you here for the end of the year here. Capital gains and losses. Harvesting gains and losses to offset gains and losses as far as capital transactions. So what do I mean by this? You sell some stocks, you sell some bonds, mutual funds, maybe have some real estate, other sales that are going to generate capital gains. If you know that you're going to have gains, you may want to sell some stocks or other investments that have losses so that you can offset some of the gains. Now, when you do this, I want you to be aware of the wash sale rule. And this comes in, and a lot of taxpayers are not aware of this, and so they don't understand what they're doing. And so here's an example that we have a $50,000 capital gain that we're going to pay tax on. And let's assume that we have a $10,000 loss in some stock. So we have a $10,000 loss in IBM stock. We go ahead and sell the IBM stock. We can then offset the $50,000 gain with the $10,000 loss, and means that we only have to pay tax on the $40,000 of gains. But if we turn around and within 30 days of that sale, we buy the IBM stock back, we now do not get to use the benefit of that $10,000 loss. So if you want to use this strategy, you have to make sure that once you have the losses, you have to wait out this 30-day period plus a day. So we got to be at least 31 days out before you can repurchase the stock. And I think that it's something that a lot of people don't understand, and you can end up losing the benefit of the loss because you weren't aware of this wash sale rule. Now, on the flip side of the wash sale rule, understand that it only applies to a loss and not to a gain. So here's another strategy where, if I go back to this slide, I'm talking about harvesting losses here to offset gains. On this slide here, the next one, I'm looking at ways that we can incur gains that we're actually going to try to pay tax, either at a very low tax rate or possibly at a 0% tax rate. And that's not, I'm not misspeaking here. As you'll see on the next slide, there's quite a bit of taxpayers that can get into paying 0% rate. So in the prior example, let's say that my IBM stock had a $10,000 gain and I'm in this 0% bracket. I could sell the stock, get my $10,000 gain, and turn around and buy it the very next day, very next minute, I guess, in this instance, and get my basis stepped up without having to pay any tax. So again, different strategies between looking at it from the perspective of, do I have big gains that I have to be concerned about? In which case we need to look at losers here. Or do I have a situation where I have a pretty low or minimal or maybe a 0% tax bill this year, or somebody in my family does? Maybe I could give some stock to a member of my family and have them sell it. But there's a lot of different strategies here, even if we are in the higher tax bracket. So we can sell winning stocks, estimate the gains, reset the basis, and then harvest some losers in this. And so what we're doing in this instance would be incurring capital gains, but then offsetting the gains with losses. Remembering again, the wash sale rule applies to the losers, but not to the winners as far as the taxes go. But once we're looking at that, the chart on the left is our single rates, and the chart on the right basically doubles those rates and has the married filing joint. So you can see on the chart on the right that if I'm married and I file joint and my taxable income, let's say, is $70,000, I would pay no tax, no capital gains tax on at least at the first 8,750 of gains. And of course, on the left side here, the singles, again, just one half the married. But these tax rates can be very low, even if we're in the 15% rates on the capital gains side. Remember again that we don't know what the capital gains tax rates are going to be in the future. My guess here is that they're not going to be lower than what they are today. So plan around using these tax rates here for 2019 and for 2020. I wouldn't expect them to go into 2021 without some changes here. So you may want to be incurring capital gains, and I know that sounds a little strange that we want to up our tax bill, but in some instances it could be the right move. Other moves that we can make as well, I'm not talking about 1031 exchanges, but that is a way that we can avoid some of the capital gains on real estate transactions. And for any real estate investor, and I know that I've done several webinars on 1031 exchanges, but it's something that you want to look at if you've sold a property recently and have a big capital gain and don't want to have to pay the tax this year. Another opportunity to avoid paying taxes this year is to invest capital gains into what are called these QOZs or the QOFs. And these are qualified opportunity zones or qualified opportunity funds. And what it allows you to do is to take capital gains from this year and either defer them or reduce them, or in some cases you can eliminate capital gains depending on how long you're investing in the fund. So one possibility is that you could sell some stock today, let's say at the end of December, and then within 180 days make this investment in a qualified opportunity fund or in a qualified opportunity zone. So you could make the sale today, but have the sale today, but make the investment, let's say sometime in early 2020. So the investment can be spread out over 2 years, but it does allow you the opportunity to be able to avoid the capital gains. So what this slide here shows us is that if we, let's say, have a $100,000 capital gain and we invest it into an opportunity zone, we don't have to pay tax on that $100,000 capital gain until 2026. Then, if we hold it at least 5 years or 7 years, which if we're holding it through the end of 2026, we'd be doing it that way, instead of paying tax on $100,000 of deferred gain, we would then be able to reduce it by 15%. So we would only pay tax on $85,000 instead of the $100,000. And if after 10 years of holding, so obviously this is a very long-term holding period for this type of investment, but if we hold it 10 years, whatever the $100,000 investment turned into is tax-free. And so let's say we could turn that $100,000 into $500,000 in 10 years, the $400,000 of capital gains would never be taxed. So again, this is something that I'm not an investment advisor, but from a tax perspective, it's an excellent, excellent opportunity. Okay, let's move on now to other opportunities beside the opportunity zones. And this gets into some of the bunching issues, and again goes back to Jason's question on how do you get your income down in certain years for these Roth conversions, or for other reasons as well. But for the Roth conversions and how I would be approaching this is I would first look at what my standard deduction is going to be. And this is where we're either itemizing our personal deductions or we're taking the standard deduction. So in 2019, if I'm married and I file joint with my spouse, my standard deduction is $24,400, meaning that if I'm going to itemize my deductions, I need at least 24,401. And this becomes an important concept, I think, because we have to start looking at the possibility of bunching our deductions here. And what I mean by that is going back to this 24,400 number in the middle of this slide. When we add up our mortgage interest, we add up our charity, we add up our state and local taxes, and I'll talk about the $10,000 cap there. But when we add up all these numbers, is that number over 24,400 or not? And let's say that the number is considerably higher. Let's say it's 30,000 or something. We know then that any more itemized deductions that we have are going to be fully deducted this year. So if we have 30,000 of deductions already, if we contribute another $100 to charity, we're going to make the deduction 30,100. Likewise, on the flip side of that, let's say that all of our itemized deductions only add up to 10,000 or 15,000, something well below the 24,400 that we would get on the standard deduction. In that case, we would claim the standard deduction and maybe try to push out a lot of these expenses into next year when we may be able to itemize. So again, when we're looking at the bunching here, let's assume that either we're really close to that 24,400 number or we're over it. And so now what we want to try to do is get that number higher. And the higher that number goes, the less our taxable income is and the less income tax we pay. Or I guess one way to look at it is we could convert more of a traditional IRA to a Roth if we can up these expenses. So medical expenses, 10% of our adjusted gross income rule, meaning that we have to have quite a bit of expenses or relatively low income to be able to benefit that. But if we can, the list that I gave us before on the medical expenses can also apply here to the expenses on the itemized deductions. Charitable contributions, we can bunch these up. Same with our state and local income taxes. But remember, there's a $10,000 cap on that. Mortgage interest, what if we prepay our January 2020 payment or a payment or two to bump up our mortgage interest to get us into higher tax deductions? Margin interest, same way, make sure you pay it, though, before the end of the year. So we're bunching up our income and expenses. And as this slide shows, not only can we do timing with expenses, but we can also do timing with our income. So if we're going to get a bonus this year, maybe we want to make sure that we accelerate it into 2019, or maybe we want to try to push it out into 2020, depending on where we think we're going to be as far as the lowest bracket goes. So if we think that 19 is going to be lower than 20, let's tax it this year. If it's the flip side of that, or if it's going to be really close, let's try to defer it into 2020, if at all possible. And businesses, most of us have cash basis businesses. We're not on the accrual basis. And so we can also time our income as far as our ability to send out invoices and what have you. So if we expect our 2019 income to be more than 2020, then we want to be able to defer out billing and accelerate expenses, right? So we can reduce the 19 income. But if we reverse that and income in 2020 is going to be higher than it is this year, then we want to accelerate our billing and defer out expenses. It's going to be about the same both years. I prefer to defer out the billing so we can push the income out into 2020 and bring any expenses into 2019 that we can. One question I get asked a lot, though, business expenses on the credit card. If you charge it in 19, you pay it in 20, you can deduct it in 2019. So one little kind of weird rule as far as the business deductions go. Another way, too, as far as when we've been looking at the conversions and retirement plan distributions and what have you, this is a strategy that isn't often thought of, but if we're over age 59 and a half, and the reason we use that is because if we're under that age and we take distributions from a retirement plan, we could pay a 10% penalty. But once we hit this 59.5, we don't have to pay this penalty. But if we have a very low income this year, we may want to take some distributions from the retirement plan, even if we're not required to do so, because we can have them taxed at a lower rate. Or again, do the Roth conversion this year as well, because we're in a lower tax bracket. So again, a lot of this comes into play with trying to sort of manage or sort of massage the numbers to get us to the best tax situation possible. Harvesting the capital gains and losses. Remember that all of our capital losses that we add up, we can only deduct up to $3,000 in excess of our gains. So if we had $100,000 of losses, and let's say we had $90,000 of gains, we would have that $10,000 excess loss. Only $3,000 could be used this year, and the other $7,000 would get carried into next year. So we want to be able to look at, what are our stock positions, our mutual fund positions, or any investment positions that we have as of today, and then would we be better off to sell them before the end of 2019 to maybe take advantage of some of the benefits of lower tax rates this year than next? Or again, vice versa. You may, if you're going to have higher brackets this year, look to harvest as many losers as we can. But again, a lot of this becomes a math equation for us to determine how much of gains and losses can we utilize. Did we have any bad investments? Maybe that didn't go down to zero, like a totally worthless security, or like a bad debt deduction or a bad debt loss would be. But maybe you had some investments where you paid $20 a share and it's worth $5 a share, and it may be worth cashing out. So consider all of these different possibilities from a tax perspective, so that you can maximize all of the different possibilities. All right, a couple more final points here, and then I'll get to some of the questions. Paying your children. I get asked this question a lot from business owners that need to be aware, though, that any of the pay or the compensation needs to be reasonable based on time, effort, age, and abilities of the child, of the employee in this case. But you can see how much can be paid to each employee, child employee, I guess, for each of these years without any taxes being due. So a quick example of this, very hypothetical, but we have two kids. One's making $10 an hour, one's making $12, one's working more than the other one. But adding both of these amounts up, we come out with a $16,000 amount that the business can deduct, but that the children, I guess in this case, neither one of them pay tax on. And so we can get this big tax savings for the paying their children, where, again, this comes into the intra-family planning, where not intra-entities or what have you, but again, the opportunity to be able to deduct this, in this case, $4,000 and $12,000 amounts on the business return, have it reported on the child's return, and have it not be taxed. Other deductions that we can look at in the last few weeks of the year here, any equipment that we're going to buy, we can get a full Section 179 deduction. This can also be heavy automobiles as well, over 6,000 pounds. Bonus depreciation, 100%. The main thing that I think to keep in mind here with any of the bonus depreciation or any of the Section 179 is that the second bullet point controls, and that is you must place the asset in service in 19 to get the deduction. So if you go out and you buy a vehicle, let's say a 6,500 pound vehicle, and you first use it for business in January, you do not get a deduction this year. Same thing with the computers or anything else that you may have. So again, Section 179 and bonus depreciation certainly can be used now at the end of the year here, as long as you pay for it and you put the asset into service sometime this month. Also, any business expenses due in January, prepay them. You can do that with state and local taxes, understanding that while the $10,000 cap applies on individuals. It does not apply on businesses or real estate investors. So if you want to make a prepayment of one of your tax bills that may be coming due early next year to get to accelerate the deduction, maybe a strategy that you want to look at. Also want to look at the planning opportunities here in the last couple weeks, but also more importantly, I think for the beginning of next year is to make sure that you understand this QBI tax stuff that is pretty new. QBI meaning qualified business income applies to any business but a C corporation. That's any business that you can think of except for a C corp. So anything that's going to be a flow-through entity gives us this possibility that we're going to get a 20% tax deduction off of the income. There's different phase outs depending on the type of business, how much money we're earning, how much wages are being paid, value of business assets. And as anybody that's seen me speak live in the last year, I use this slide a lot just to show you that this can apply to a lot of different businesses and gives us a huge, huge bang for the buck tax-wise. When we can drop off 20% of our net income from a business, that can become a pretty serious tax deduction. So I would recommend, certainly you can Google this or whatever as far as looking at the different charts, but the main thing is that if you're single and your income is under this 160,700 in the green down at the bottom there, or married filing joint where your income is 321,400 or less, you're going to qualify for this 20% deduction. And again, it's something that we all need to take advantage of. And last point I want to make, last topic here, 529 plans and education saving account plans. These again, very, very tax favored. May want to make the contribution in the next couple weeks here to get them into the accounts for 2019. Some states do allow a tax deduction, so you want to get them in as soon as possible. Feds don't have a tax deduction, but we get this tax-free growth, assuming that the money is used for education. The other factor to consider is the last bullet point, and that is that if you have money in one of these 529 plans or ESA plans and you have expenses, make sure you get them out before the end of the year. So withdraw the money at that point. We want to look at, too, the IRA plans that we want to avoid the 10% penalty. We can do that with the higher education expenses as well, but there may be income tax due. So a couple different strategies or options that we have on the IRAs and use of educational accounts. So anyways, back to the list of the 13 here. And boy, that took me a while to get through these 13 topics, but hopefully a couple of points made some sense to you. Hopefully a couple of them you can throw into play here in the next couple weeks, or certainly at the beginning of next year to get your 2020 off on a right start. So anyways, I'm going to end my presentation now with a couple quotes here from Jimmy Carter and from Albert Einstein, and I think Kendall has the questions that we're going to get through here in the next 20 minutes or so. But anyway,
thanks, Scott, so much. We really appreciate it. Honestly, I love it. I learned so much, and I'm always impressed too. We got a lot of people on the call tonight, and they could be doing a lot of other things, but they're here listening to what a lot of people consider taxes is boring. But I tell you what, it's actually very exciting once you understand it, like you teach, Scott. I tell you what, there's nothing more exciting because at the end of the day, you keep more of what you earn, and that's what it's all about. So thank you.
Absolutely.
I appreciate it. All right. So we have a lot of questions, guys, and I honestly, I don't know if we're going to get through all of them, but we'll do our best. So I'm going to reach in and grab a few questions we had come in early. And Scott, I'll just read them out to you. We'll go ahead and shoot from the hip if that's all right.
Yes, sir. Let's do it.
Okay. All right. So we had an email come in. This is from Joyce. She asked about losses on sale, losses in business, and theft losses. So basically, it looks like she had some losses due to theft through a business deal that didn't go correctly, through a loan that did not close. So they wanted to already deducted travel expenses, but she was wondering if it's possible to deduct more, like commissions on the loan, loss of time, that sort of thing, on our taxes. Yeah.
Yeah, that's a good question. I mean, any expenses that were actually paid out of pocket, so travel expenses, if there were commissions paid, but they didn't get reimbursed or whatever, all of those are deductible. But the loss of time or the expected profit you were going to make on the deal, that's not going to be deductible. So, if you thought you were going to make 50 grand on the deal, but the deal fell through, only out-of-pocket expenses are actual tax deductions.
Yeah, we get that question a lot. So it's really just clearly defined as out of pocket. There's no way to stretch that anyway at all, huh, Scott?
No, there really isn't, and that's one of the benefits of being a cash basis taxpayer is we don't pay tax on money we don't get, but then likewise we don't get to deduct when we don't receive the money, like in this case. So that's too bad for Joyce, but a lot of us I've been in that position, and hey, we're just stuck.
The cost of doing business. I guess that's part of the game, right? That's a great way to look at it, Scott. All right. So, which entity is better based on the new tax law? Is it C corp or S corp? And you covered that a little bit.
Yeah, well, that's going to be tough, but with the C corp S corp, the C corp is going to have its own tax status, where the S corp is going to pay taxes at the owner level, and so it gives us a nice opportunity. Kind of fits in with what I was talking about tonight, to maybe keep money off of the personal return by using a C corporation, and then also having an S corp or LLC on the side to get the benefits of that 20% QBI tax deduction. So there's a lot of stuff that could come into play, and the interplay between those two, I think, is going to be that's your intra-entity planning that I was talking about before. But I think we've done entire webinars, Kendall, on how it's
S versus
C. A little more
C.
than what we can get into right now.
Yeah, it is. Al's asking about a rehab on a house that he rehabbed this year and rented in October. What can I deduct this year versus depreciate?
Well, a lot of the rehab work can be done with using bonus depreciation. So that would be the first thing I'd be looking at there on the rehab part. And then certainly, what can you expense? So, as far as the rehab part goes, part of it is going to be going into building typically, where it's going to have to be depreciated, but other stuff can get use bonus depreciation, like maybe some landscaping or driveway work or something that has what the IRS calls a 15-year life, something or carpet appliances, things like that. So separate out all the stuff that you can use bonus depreciation on, deduct it in full in 2019, and then whatever has to be depreciated, you'll start that depreciation sometime, I guess, in October, whenever it was ready.
It's a great question, and it leads us right into Tim's question about cost segregation. He did a cost segregation on a property that was purchased in a 1031 exchange. Original cost basis was $97,000, sold for $165,000, and bought new for $212,000, and did a cost seg. So how do you handle a cost segregation in a 1031 exchange?
That gets pretty complicated as far as what you're doing, but what you'd be looking at there is basis adjustments. And for those who don't know this gets into a little more complexity than probably this webinar, but a cost segregation analysis gives you the opportunity to take a rental property that, let's say a residential property is depreciated over 27 and a half years. And if you pull out some of the personal property, appliances, AC units, and a whole bunch of other stuff, you can get that basically segregated out of the 27 and a half years and get it into a much lower depreciation period, which then gives you a much bigger tax deduction. And when you use that with bonus depreciation, it gives you a really killer tax deduction here. But when you start combining that with 1031 exchanges, then you've got to deal with the basis issues of the depreciation between the original property and the property you got in the exchange. But it's a good problem to have, because you're able to up the deductions and then also defer the taxes by use of the exchange. So yeah, that's a very good strategy to use if you've got the real estate and certainly the wherewithal to be able to do it.
Yeah, that's a whole nother webinar topic. Great questions, guys, though, really are. All right, so Mohammed is asking, he has a new property management business and reported a loss last year and may report a loss this year. How long can we continue to report losses without adverse effect?
Well, you can. There's no tax rule that says. I mean, you could have 10 or 20 years of losses in a row, and it still could be legitimate. But obviously, that would not be recommended. IRS says that if you've had profit in 3 out of the 5 years, it's presumed that you have a business and you have a profit motive. Likewise, I guess if you have a loss in 3 out of 5 years, the IRS, if they audit you, could say, we think you have a hobby here and not a business. And basically all we would do there is then just show them that we're running this like a business and we're not intending to have losses forever. And, you know, sort of like Amazon, some businesses have losses when they start off, and sometimes it's a lot. So the main thing is to be able to show you have an intention to make a profit, and you have the books and records to show that you were running this as a business and not as a hobby.
Yeah, and I was curious. So, Scott, that question comes up all the time. So, is that honestly for hobby loss rules? Does that really happen a lot? Is that really a big deal? Because if you are working the business, you have pretty good proof, right?
Pretty much so. The hobby loss stuff really comes into stuff that could be done for pleasure as opposed to for money. So something, you know, like you're doing a property management business, that's a business, but you're an antiques dealer, you're a coin collector dealer, you're a photographer, artist, or, you know, any of these things where you see it like in horse racing and dog breeding and stuff that people may do that for fun as opposed to trying to make money at it. So I think you have to look at what are they doing with the activity, and are they really running it like a business, or are they just doing it as a hobby?
That's good. Okay, thank you for that. I appreciate it. Okay, Jancy, 5 years ago, I invested in a fixed income universal life insurance policy, or fixed index life insurance policy. I'm having buyer's remorse and considering cashing out, even though I would lose 60% of what I've invested to date because of a larger upfront premiums and cancellation policy. That's true. If I do cash out, is there any potential loss that I can take on my taxes?
That's a really good question, because you've got that into was that in a retirement plan? Is that what it said? It was a life insurance annuity?
Yeah, fixed index universal life.
So we're talking, I don't know the answer to that question. I don't know if you look at it and you have a loss on that, if it's to be a capital loss where you're limited to the $3,000 per year or whatever. That one I'd have to look up. I don't want to throw that one off the top of my head because I don't know.
Yeah, there's different laws that apply to life insurance. Yeah, that's true.
There are, and I hate to throw out what I think is the answer because I really don't know.
Yeah, that's a tricky one. I've gone through a lot of those life insurance classes, and I tell you, I don't know either. So, all right. Okay. Looks like Reg is asking, I filed a Schedule C for my LLC. In 2018, I was receiving the advanced premium tax credit for health insurance. When I did my taxes in April of 19, we were greater than 400% of the poverty level, so we had to pay it all back, or less than, excuse me. Should I have included that payment as part of my self-employment health insurance deduction, or should I include the payment part of 2019's taxes as part of the self-employment health insurance deduction? That's a good question.
The payment would have been made in 2019, I think is what he said. You have to make claim the deduction in the year that the payment was made, not in the year that the payment was made for. And so again, with the facts, I'm not sure if the payment was made in 18 or 19. But if it was made in 19, claim it in 19.
Yeah, it looks like, yeah, it's not really clear there. Okay. All right. That's good clarification. All right. How does the IRS not see the $15,000 gift when deposited into someone's account? Or is this a cash transaction and now fully loaded pocket full of Ben Franklin's? Good question.
Well, the gift could be, you can give a whole lot of Ben Franklin's if you want, but I mean, it would normally go in like a check or a transfer or whatever. Let's say you put 15 grand in there. IRS does not monitor bank accounts. Obviously, whenever you put something more than 10,000 in, there's what's called a CTR, a currency transaction report that gets filed, but that doesn't mean that the IRS is going to look at it. As far as an audit would go on it, if you get audited and the IRS is asking for bank statements, which they almost certainly would do, and they see a $15,000 deposit go in, they're going to ask about that. They're going to make sure that that wasn't taxable income. And so our reply would be, no, it was a gift from mom, and here's the letter, here's a copy of the check that said gift on the memo line or whatever it is. But the IRS does not monitor, everybody's bank accounts and know exactly what we're doing.
Yep. So it comes down to your report. That's true. Okay.
Pretty much.
All right, Nick. All right, good friend Nick here. He's asking, I'm in the process of selling my property to a developer for $1.2 million. 8 years ago, I purchased for $230,000. Hey, good problem to have, Nick. It's under my name currently. The deal may take up to 2 years before closing. What should I do before I send the papers so I don't get slammed with a good tax bill? Any suggestions?
Oh, well, I think I would evaluate. The first thing I would do is evaluate the capital gain. Make sure that we look at the sales price, we look at the purchase price, we look at any money that's gone into the property over the last whatever number of years. If there was any improvements made or whatever, let's get the exact capital gain amount then that we think we're going to pay taxes on, figure out what the tax hit's going to be, and then once we know that, then we can either agree that we're just going to take the hit, or if not, then we're going to look at maybe doing an installment sale where we carry a note over a period of years to try to spread the tax bill out over a period of years. Maybe we look at the qualified opportunity zones that I was talking about earlier. We can also look at a 1031 exchange where we could defer all of the $1 million or so profit, or you can take some out, pay tax on some of it, and do a 1031 on the rest. But the main thing is do the planning now, figure out what all of your options are, and then let's go through with the deal. Make the transaction once we know what are the best ways to do this deal from a tax perspective. So yeah, real good question.
Great question. Great problem, Nick. That's great. Okay. All right. So we just have a few minutes left here, so we'll do our best to get to the rest here. And this is a question from Season. She's asking about the capital gains exclusion. We sold our home 18 days under the 2-year mark and reinvested in another home in August. Is there a grace period on the capital gains under that 2-year mark?
And unfortunately, no, there isn't. And so what you do with the money under the 2-year mark or over the 2-year mark doesn't matter. So you don't have to put it back into real estate. What I would be looking at here is what was the reason for the move, and is there an exception to the 2-year rule? And so that's where I would start with this is, yes, you're gonna have a tax bill because you didn't satisfy the 2 out of 5 year rule for living in your personal residence. And so if you have a capital gain, you're going to pay tax on it. But there's different exceptions to that. If you move because of a job or because of health or because of a whole lot of different reasons, we may be able to get that excluded. So don't take it that you're for sure going to pay tax on that. Let's look at the exceptions.
Yeah, so she sold it just 18 days under the 2-year mark and reinvested it in another home in August. So yeah, all right. So the sales part, the capital gains, you're fine on. It's the reinvestment part, I guess, that transaction there, right?
Well, no, the reinvestment part doesn't really matter. I mean, what matters here is on the sale there, if they would have waited, a couple more weeks, a month or whatever it is, then they could have excluded $500,000 of capital gains, or $250,000 if it's a single person. But by being short of that, let's say that it's a married couple and they have $100,000 of capital gains, they're going to pay tax on that $100,000 because they didn't meet the 2-year rule. And so that's going to be the problem here. And so the exceptions could be really big. It could save quite a bit of money.
Yeah. All right. Well, that's a great question.
So, good luck on that one. I hope an exception applies.
Yeah, absolutely. Okay. All right. MD's asking, investing in hard assets using an LLC with a non-family member. With this setup, would the LLC have to file a 1065, or can it be flow through without filing separately?
Well, it can't be a single member LLC, and so it's going to be, since we have a non-family member, so at least 2, we have a partnership, which means it files a 1065. So yes, the LLC would file a return every year, and then there would be a K-1 that would go to the 2 partners, or however many of them there are. So yes, there would be, but it would be a flow-through entity. The partnership would not pay tax at the partnership level. It would get paid at the partner level.
Right. Okay. Great. All right. With the RMD going directly to a charity, you mentioned that the RMD would not need to be reported as income. If the income isn't reported, is there another way that it's reported that the RMD was actually taken, or am I misunderstanding?
No, that's a really good question. You're not misunderstanding as well, and I probably wasn't super clear on the reporting part. What happens here? Let's say you do this for $100,000. The $100,000 would actually get reported on the tax return as a distribution from a retirement plan, but it would show 0 as being taxable. And there's a little code that comes on there, and I think it's QRC. I think is what it says, Qualified Retirement Contribution. I believe that's what it is. But anyways, there's a code that comes on there so that when the IRS would get the 1099-R in this case, showing the RMD, you would then also, you'd be able to show that you satisfied the RMD and you wouldn't get penalized. So that's a really good question, because I was definitely unclear on that one. Kendall, you still on the call?
Oh, I lost you. Dang it, we still there, bro? Oh, sorry, Scott.
Yeah.
That was my mute button. So Bill asked, I just started a new job in October. They have a pension plan that I contribute to. They also have a 401k that I contribute to. I opened a Roth earlier. Am I okay with a Roth and a 401k, looks like? And he's 50 plus.
You can contribute to an IRA and a 401k in the same year. So that's not a problem. Just the main thing with contributing to a Roth IRA is you have to make sure that your income is under the thresholds. And I had that slide up before. I don't remember what the numbers are, but not everybody, if your income is high enough, you can't contribute to a Roth at all.
There you go. So it depends on your income. Okay. All right. Wayne asks, my dad is 94 and owns 3 properties worth $1.1 million. He is interested in selling these properties. If they sell, will he have to pay long-term tax on any of the properties? Since it is 3 different properties, the largest sale will be $700,000 for homestead.
Well, there could be 2 different properties involved here. I mean, if this is all your personal residence and it's split up into 3 different parcels, you may have to look at how it's zoned and how it's titled and what have you. But if he's married, he's going to get a $500,000 exclusion and a $250,000 exclusion if he's not, to go against any capital gains. But yeah, it sounds like there's almost certainly going to be capital gains involved there. And I think what I would be looking at here is, if he doesn't need to sell the property and you can put it into an estate plan, when the father passes away, whoever inherits the property would get a step up in basis and pay no tax. So I think here, unless dad needs the money to live off of, the family would be better if dad doesn't sell and through an inheritance it gets sold that way. just one more planning opportunity.
Yeah. All right. Great question. Okay. All right, Scott, we got time for one or two more?
Let's do one more, and then we'll call it an evening.
Great. Okay. All right. Chris asked, can you talk about rolling over funds from an IRA to established Roth after retirement? So rolling over from an IRA to an established Roth post-retirement. Any problems with rollovers from Roth to from traditional to
No, there
Roth?
wouldn't. No, there would be no problem on that one because you can do the rollover pretty much anytime you want. I've seen a lot of financial advisors say, obviously the longer you have to retirement, the better the Roth conversion is. But you can also do that in retirement as well. But again, it's going to be a taxable event.
Okay. Great questions, guys. Thank you so much. And Scott, really thank you so much for your time tonight. We really appreciate it. Incredible information, incredible knowledge. Anything you want to add before we close?
No, I just want to thank everybody for being on the call here tonight. Wish everybody a great holiday season, and look forward to the 2020 Protect Wealth events. Thanks, Kendall.
Thanks, Scott, so much. Everybody, thank you. Please reach out to us at protectwealth.com, or you can reach us directly at 800-276-1430. You can give us a call during regular business hours. Likewise, thanks for your time again, and we wish everybody very Merry Christmas, Happy Holidays, and have a great night.